You find the setup. This is a standard breakout trade, the kind that made money for years. Price tests a level, breaks through on high volume, and you click buy right at the textbook entry point. But in 2026, the old rules don't just fail, they fail instantly. Your position collapses before you can even move your stop loss. The first reason you just lost capital is invisible to your charts. Overnight, regulators like the ESMA or the FCA updated their leverage frameworks. If they slashed the limit on minor pairs from 1 to 100 to 120, your required margin just quintupled. You didn't lose because the trade was bad. You were liquidated by a rule change you didn't track. The second reason is mechanical. The interbank market is no longer the only player. High-frequency algorithms from non-bank providers now dominate. They use lightning-fast execution to create liquidity traps, deliberately pushing price past resistance to trigger retail buy orders, only to dump their institutional size and hunt your stops. Using a 2025 playbook in this environment is essentially donating your margin to the institutions. To survive, you have to read the forces that are currently invisible to you. To counter these institutional algorithms, you have to adopt artificial intelligence, not as a bot trade for you, but as a data processing assistant. If the institutions are using math to hunt you, you must use math to spot them. Modern AI tools process more than just price. They calculate breakout probabilities and volatility forecasts by analyzing decades of data against institutional flows. When AI flags a low probability on a classic setup, it identifies algorithmic footprints of a liquidity trap before you commit capital. Since institutional bots are designed to exploit the breakout and buy reflex, your new entry tactics must become more patient. You wait for the pullback to retest the level rather than chasing the initial move. By switching to Heikin-Ashi charts, you use mathematical smoothing to filter out the high-frequency noise that institutions use to create panic, revealing the actual direction of the trend. However, even the best AI can develop bias if market conditions shift too quickly. To protect yourself, you diversify your analytical tools, pairing AI-driven sentiment with a rigid, manual grid trading strategy. This dual approach allows you to process market sentiment faster than a human, while maintaining the defensive posture needed to survive institutional traps. Beyond the charts, the era of synchronized global banks is over. We've entered an age of policy divergence, forcing nations onto conflicting economic paths. This divergence is what creates the massive, multi-month trends that define the 2026 market. You are no longer just trading price action. You are trading the gap between different national realities. On one side, you have the U.S. Federal Reserve, holding interest rates high at 5% to crush stubborn domestic inflation. On the other, the Bank of Japan is forced to keep rates near zero to stimulate a sluggish economy. This massive interest rate differential is the engine behind the currency's move. Traders exploit this gap to earn daily interest, or carry. But in 2026, you must watch the geopolitical headlines. Any regional conflict can send that capital screaming back into safe haven currencies like the yen or the Swiss franc in a matter of minutes. When traditional fiat pairs are stuck in range, you look to central bank digital currencies and tokenized assets. By trading tokens linked to baskets of emerging market currencies, you can gain exposure to economic growth in regions that traditional Forex brokers often ignore. Long-term profit in 2026 requires you to identify these massive policy gaps and use new digital instruments to hedge your risks. Now, look at that same trade from the beginning, but executed with the 2026 playbook. This time, you don't buy the breakout. You wait for the pullback. You check the AI sentiment score to ensure it isn't a trap, and you verify that the trade aligns with the current policy divergence between the two nations. This is a high-probability execution. Because the market is evolving at this pace, your skills will expire if they aren't updated. You must commit to testing one new indicator or tool every quarter, giving yourself 4 clear windows a year to adapt your strategy before the market moves past you. Flawlessly running this data-heavy strategy requires a platform built for modern speeds. If your broker's execution lags, the institutional algorithms will fill your order at the worst possible price. The FXNX ecosystem, featuring NXAI and ultra-fast execution, is designed for this specific landscape. Use the tools built for 2026. Stop reacting to the future and start trading ahead of it.